Good morning, good afternoon, good evening, powerhouses. This is Dr. Dabosky. Welcome back for another short video on Chapter 2, which deals with accounting during the period. Before we get into that, I'd like to do a quick review of the accounting equation and elements of financial statements. Before we get started, though, I want you to remember this little module, we're going to be working really hard. Matter of fact, we're going to be working like...
Baby, I'm playing on you tonight. Hunt you down, eat you alive. Just like animals, animals like animals.
That's right. We're going to be working like animals. So, if you should, in your studying to this point, you should notice that our basic accounting identity, remember the rules and grammar of the accounting language, the first part of my metaphor, involves where assets are on the left side, which are our debits, and notice after the equilibrium sign, right, that we have the credits, and then the stockholders' equity accounts are also credits. We can break stockholders' equity into common stock and retained earnings, which are both credits. And then finally, we can take the retained earnings and we can say what goes in there is the beginning retained earnings plus the net income minus, look at the minus sign, dividends, and it's a minus because it's a debit in a credit account. So that means it must do the opposite, which means it decreases, and we can see that through the mathematical sign there. Finally, we can measure net income as revenues, which are a credit, minus expenses, which are a debit. Again, the minus sign is telling you that this account has to be opposite a credit, which means it's a debit. Now let's review debits and credits together. I have an acronym which I use, which is called DEALER. DEALER stands for, number one, the debits. The D stands for dividends. The E stands for expenses and losses. And A stands for assets. So your debits are your D, your E, and your A. Your liabilities or your credits are your liabilities, the L in dealer. The O stands for owners or stockholders' equity. And the R stands for revenues and gains. So again, DEA are your debits. These are the only 6 types of accounts that you'll deal with in dealer. So all transactions will involve either affecting a dividend, an expense, of some type of asset, some type of liability, some stockholders' equity account, or some type of revenue. Again, if we look at this broken down, on the left side, the debits exist. Debits increase with debits and decrease with credits. On the right side, the liabilities, we increase them with credits and we decrease them with debits. You'll notice that these are mirror images of each other. They're opposites because they're on the opposite sides of the equilibrium. So if you increase the left side with a debit, then that means you must have to increase the right side with a credit because it's opposite. So this is our system of debits and credits. This will serve as a foundation for all of recording your transactions. So you should familiarize yourself with this system of debits and credits. Now let's do a little bit of a review. Let's look at the correct format for recording transactions, or what I said in the second part and third part of my language metaphor was that we'd learn to write in the accounting language. Let's look at this simple example where we're going to borrow cash by signing a $1,000 note. The sight word here, borrow, is very important. It means that you're borrowing, and if you're borrowing something in your own personal lives, that means you're getting more liabilities. So the company, remember, you always are going to record transactions from the company's perspective. So borrow means what? Well, you borrowed cash, so that means an asset increases by $1,000, and you signed a note, which means you did not pay for the liability that you've borrowed yet. You're going to owe it in the future. So you'll set up a notes payable. Payable is your word for a liability. So you debit an asset, you credit a liability. And then in this case, since you're increasing an asset and a liability, which are your cash and notes payable, both are increasing. Let's look at 2 other examples here. And then I'm going to hide this information to see if you can follow along. So we're going to do these together. The first example is we purchase office supplies on account. There's a sight word here, on account, which means basically you did not pay for cash for it yet. So how do you record this transaction? Well, you got supplies, which is an asset, so assets increase, and you did it on account, which means you must have also incurred a liability, so liabilities increase. There's no change to your stockholders' equity because revenues or expenses or dividends were not involved in this transaction, so it just involves your assets increasing and your liabilities increasing. We would record this by recording the debit account on top and the credit account on the bottom. You'll notice this is the correct format for recording transactions. Debit account always goes on top, the credit account always goes on the bottom, and we slightly indent the credit name and credit amount. Let's look at number 2. Pay full amount for the supplies that we just purchased in number 1. So how do we record something where we're paying for something? Well, the word pay is a good sight word to tell you that whenever you see pay, paid, generally means your cash is going down, so assets are decreasing. But you paid the full amount for the supplies. Well, you didn't pay for them in number 1. You had a liability, accounts payable. So you have to decrease the liability. So on the left side, assets go down by $1,500, and on the right side, liabilities go down by $1,500. No change in stockholders' equity. This is a good transaction because it's zero, up, down on equal amounts on both sides. So therefore, that is a balanced transaction. Again, how do we record it? We put the debit account because we debit accounts payable because it's decreasing the liability. That's how you decrease the liability. You debit it because it's normally, remember, it's a credit. And we credit our asset cash. Now let's look at some transactions where you're going to try to see how to fulfill this template. We provide services on account to customers. Well, number 1, there's 2 sight words here you need to know. Providing services means that the services are earned and revenue has been generated. On account means you have not been paid for the services that you've provided, so you need a placeholder for cash. What is the placeholder for cash? Correct. Well, we do know that we provided services, so we need some type of current asset. So assets increase. And stockholders' equity increases because we've earned the revenue, and revenues go into, remember, it's part of retained earnings, it's part of the net income calculation. So we record the transaction as a debit to accounts receivable for $4,000 and a credit to service revenue, where revenues and stockholders' equity both increase. Now let's receive the full amount on account in number 3. Well, remember we had a placeholder, which by the way, accounts receivable is what I call cash's best friend. When cash is not readily on site, accounts receivable steps in until cash is received. So now the cash comes in the door, so we need to swap in the cash asset for the accounts receivable asset. So in this case, both assets will increase and one will decrease by equal amounts. So we would go ahead and debit the cash asset because now that's the asset that takes the place of accounts receivable, and we no longer need accounts receivable, so we'll credit the accounts receivable asset for the same amount. Let's look at another example where we pay workers' salaries for the current month. Here is a sight word, current month. Whenever you see that word, you should think expense. You paid for it, so that means you used cash. So how do you record an expense? How do you increase an expense? Remember dealer? DEA, E, expense, means debit. So we're going to go ahead and debit an expense and credit cash for this worker's salaries. In 6, let's say we received the current month's utility bill of $2,100. We received the bill, but we did not pay it, but it means it's incurred. An expense that's been incurred still has to be recorded as an expense. However, we haven't paid it yet, so we need a liability to step in until we pay it. So in this case, assets don't change, but our liabilities go up, and our stockholders' equity goes down because of why? Because we have an incurred expense, and expenses decrease retained earnings, and if retained earnings is decreased, that means stockholders' equity decreases because retained earnings is a component of stockholders' equity, as we saw earlier on when we reviewed the basic accounting equation. 7, so number 6, record a transaction by debiting utilities expense and crediting utilities payable. How about if we issue common stock for cash to investors? Well, this is a common entry done in accounting all the time. This is like an IPO, an initial public offering, when a company sells its stock for cash. Well, assets are going to go up big. which will be cash, but stockholders' equity in the form of common stock will also increase. So we'll debit cash and credit common stock. How about we go ahead and pay a dividend, a cash dividend, to the common stockholders? Remember, the D, dividend, is in DEA. That means it's a debit account. So that means your assets are going down because you paid. The sight word paid means cash goes down, assets go down. But also stockholders goes down because why? Because we debit dividends. And remember, dividends has a debit balance. So we debit dividends and we credit cash for this dividends payment. In summary, what are the 6 types of accounts you need to be familiar with in all of your transactions? What are payments to owners called? Dividends, good. What's the cost of producing revenues? Expenses. What are the resources owned by a company? Assets, very good. What are the amounts owed? Generally to creditors, we call those liabilities. What are the residual claims of the owners or the stockholders called? That's right, stockholders' equity claims. And then finally, what are the sales of goods and services called? Revenues. Well, there you have it. That's our accounting, and that's our debit credit system in accounting. I will post a short review of the key sight words for recording all transactions. And remember, in this class, we just worked this module like
Maybe you think that you can hide. I can smell yourself for miles, just like animals, animals like animals.
So that's right. Let's continue on here and work like animals and knock this class out, and let's everyone get A's in this class. Okay, so work hard, read, get your homework done. If you have any questions, post, talk to each other, help each other. You guys are doing great. Keep up the good work.